Hi, everyone. It's Bill with Carolina Hard Money, Carolina Capital Management, and our special guest today, coming live from the other side of this table,
I like how my last name's Davies.
Oh, yeah.
Wendy Sweet and Jonathan Davies.
Yeah.
Now
Davis.
no one knows who I am.
Yeah.
He's incognito.
There's no E in there, right?
Yeah.
So
right.
don't forget to subscribe, share, and like. Our website also is carolinahardmoney.com.
He says with such
We do.
excitement.
So in the next few shows, Wendy will be doing the opening.
That's fine.
If you're a borrower, because we do bridge loans, short-term bridge loans for commercial and residential properties, click the borrower tab. If you're interested in passive returns and would rather invest in notes, buy notes, or in a fund, click the investor tab. So our
I think you just dinged.
show today, we had some special guests, and they had an emergency.
They claim
At
they
the last
did.
minute.
They claim they did. I think they're just checking. Just kidding.
They heard Bill was going to be on it, and they just
They heard his big words. They got afraid of all of that.
Yeah. They were not amenable to being on the show because
Yeah.
Bill's using such.
So instead of just posting a recording of a previous show,
We're gonna make up some more questions. Actually,
well,
we
we're not
have a
making
lot of
them up.
we have a lot
were
of
actually
questions.
sent to us.
Yeah, we actually came up with 100 in house with just our employees, our team. We all just started throwing out questions that we'd been asked, and then we sent out a Survey Monkey and got a great response off
Yeah.
of that too. So we might resend that out again and give you another opportunity to add some more to it. So we're actually going to hit some of the questions that came through the Survey Monkey, and I kind of have them right here in front of me.
Yeah, feel free if you all think of a question, want a question answered, throw it in the text, and we will do our best to answer it.
Yes. So you can text those in the chat box.
Yes, yes. And this is what's called thinking on your feet when
Yes.
you're kind of given notice at the last minute that things have changed.
The best thing to do is ask Bill what things mean. You know, that's the way. We'll do a whole episode. I think Don in the
What
last
does that
one.
acronym stand for?
He
Well,
stumped him.
Yeah, Don in the last one. We'll have an episode called Stump Bill.
That
Listen,
should
if
be
I
easy.
don't know it, I can make it sound like I do.
Yeah. Yeah,
Yeah.
that's the key, right?
Yes, please send us your money. Bill will sound like he knows what he's doing.
All right. So what's our
First question. Let's
what's
see.
our third question for the day?
Let's continue to talk about. Let's see. There was somebody that asked. Oh, I like this question. It says, "What is the current and future status / outlook of Carolina Capital Management regarding investments, interest rates paid, quality and diversity of projects, average loan size, performance, delinquencies, and defaults?" I think that's just a great open question. I don't think we can talk rates like what we're paying right now. That would have to be a private conversation. But
Yeah, that the
On the lending side, we can talk about.
Yeah.
Listen, if you're a lender and you're buying individual notes, you're getting whatever the note rate is,
Right.
And you'll know that in advance. And our note rates run from 9.99 to what 12.
12, 13%.
yeah, we've
somewhere.
got some a little
So-
over that, but
yeah,
So
not
each,
many.
each note that's available is going to have a different interest rate on it. That said, none of us have a crystal ball. Okay, I am very optimistic about.
And he's a Debbie Downer.
I'm very
so that's
optimistic
really good.
about the single family space.
Yeah, I'm thrilled about where we are
and
right
the
now.
affordable side of
Mhm.
single family.
Mhm.
And let me give you a quick rundown on why that is. Affordable housing, and in our area specifically, it's really anything under 350,000.
Mhm.
Why is that a great space to be in? Well, as a lender, you're always looking at, and I keep going over this, how quickly can I get this property sold
Mhm.
if we end up having to take it back? And so in order to do that, you want the properties that are the most liquid, the ones that most people want, the
Right.
biggest piece of the buying pie.
Right.
And in affordable housing, you have investors that would be interested. You have first-time home buyers that are going to be interested. And then you have empty nesters that are downsizing that would be interested. So
You're Davis.
you have
Oh, I'm Davis.
you have many more options available to sell these properties quicker,
Mm.
or the quickest. That said, and again, we don't have a crystal ball, but it looks like we have a lot of people that are trying to move out of the larger metro areas, New York, LA, San Francisco. They're trying to move out of those crowded spaces and into more suburban areas. We have a friend in New Jersey who got 12 houses that he picked up that were all in the affordable range. They're all 300,000 or less.
Mm-hmm.
He's just outside of New York City, and he bought 12 houses and had 10 under contract within 1 week.
Wow.
1 week, because of the exodus out of the bigger cities.
Right.
So it's not just here in the Carolinas and the Southeast that this is going on. This is just anywhere outside of the major metro areas. You
Yeah.
have people that were crowded into apartments. Let's assume a family of 4, both husband and wife work, and now they have kids that have to be homeschooled.
Right.
So those apartments are a lot smaller now,
Mm-hmm.
right?
Yep, very much
and
so.
they need space.
Right.
So it doesn't necessarily have to be space inside, but if they have a nice, fenced in backyard to play in,
Yeah.
that's giving them extra space. And if you're
Right.
living in a crowded apartment in, Manhattan, you're not going to just tell your kids to go out and play. You're going to go out to the park with them.
Right. Right.
You can do that in your own house if they're playing in the backyard.
Yeah, it's important that you have a fenced-in backyard, that you can put your kids in play, and a working lock on your back door.
Yeah. Stay outside. That's exactly right.
But
Says a
it's
man
not-
who has his third young one on the way in the next couple of weeks, but 2 little ones at home. That
Yeah.
But it's not just about purchase money loans. It's also about rental properties. There's still plenty of people that can't or do not desire owning a house. They still rather rent.
sure they want to be
but
in
they
one.
still want to be in a single family,
Mhm.
Exactly.
and they want to be in the more in the suburbs. So for that reason, I'm very optimistic about the single family space, whether it be long-term rentals or fix and flip. Even wholesale is going to pick up.
Right, which is the direction we took in January of 2019. We changed everything with
So
the
as far as
direction.
diversity goes, you're going to get diversity geographically,
Yeah.
Mhm.
property types, and the large amount of properties that you would have in the fund. We are going to stick into the single family for the most part.
Majority.
Probably
Mhm.
10 to 15% of the portfolio is going to have multiple tenant commercial properties in it, and we'll say multifamily, self-storage, warehouse itself that can be broken down into several units.
Mhm.
Mobile home parks. We want to try and stay in residential, but self-storage is very
Very lucrative.
resilient when it comes to down markets.
Even down market and
Um,
up market, it does well in both.
But your diversity comes when we have 105 loans in the portfolio
Yeah.
Yeah.
versus just a couple.
Yeah,
Yeah.
we have over 150 actually, but I mean, you hit it. It's diversity. It's not only is it geographic diversity. I mean, I can lend to the same borrower in 48 different states. That's not really diversification.
No.
That borrower goes like, great, you're in different markets. That's fantastic. But we have thresholds that we can, we only lend X amount to a particular borrower.
Mm.
So even though we have geographic diversity, we also have borrower diversity as well. So that further mitigates risk that, if we do lend on multiple projects to a borrower and he goes down, we still have 145 other projects that are going on.
Right.
He only had 5 of them.
Right.
So.
And the diversity too. Let's not think that we're nationwide or going anywhere to lend money. We're very cautious with the areas that we're lending in the Carolinas and the states that touch the Carolinas.
Mm-hmm.
We also include Alabama, some in Mississippi. I think we've got some loans coming up in the Indiana area,
Kentucky and Indiana. I
Yeah.
mean, mostly. I mean, we're more centralized around the Southeast with a heavy concentration in North and South Carolina, Georgia, and Virginia.
Right.
Like that's really, those 4 states make up the bulk of what we do.
Absolutely. But
Yeah.
the thing is we want to make sure that that we have boots on the ground in any of those areas. We have friends that we have close relationships that do business in those areas that can be our eyes and ears and
Yeah.
help us gauge that market.
Yeah, and while we're on diversity, or loan size rather, our average loan size for 2019 for single families was 158,000.
Mhm.
So that gives you
And it was
a
up
lot
at-
of bang for your buck. It was up there close to 300
Yeah.
prior to that. On our commercial side, we were in the 800,000 range, right?
Yeah.
Mid 800,000.
Low 800s on the average commercial
Now,
size.
that doesn't mean we didn't participate in projects that were larger. We like to stay in projects that are 3 million or less.
Mhm.
Are we taking on that whole loan? No. That's one of the things that we look forward to doing, because we can participate with other funds where we only have a much smaller portion of the loan.
Right.
And we're still in a shared first position.
Mhm.
So we have just as many rights, and a lot of times we're still keeping the servicing.
Well, yeah.
as well.
Usually in
And-
most cases we keep the servicing.
Mhm.
So what that does is it diversifies our risk on the larger projects,
Mhm.
at the same time giving us opportunity to get into the larger products.
Yeah.
Right?
Oh yeah. I mean, it's the same model that like the credit unions take. You want to do larger projects, but you don't want to take on all the risk, and you don't want one borrower or borrowers to saturate your portfolio. So you split it up with other funds or other people that like and trust, and you have business relationships with.
Right.
And as far as delinquencies and defaults, our average default rate since we've been in business has been around 2%.
I think it's a little less than 2%. Yeah.
It might be a 1.5, somewhere in there. So that's pretty low anyway. Delinquencies, I was pleasantly surprised, even with the shutdown going on. We only had to modify about 8 loans, right?
We didn't even modify them.
Mhm.
It was just a temporary deferment.
Okay.
Yeah.
And
So-
was it that many?
It was 5.
It was.
5?
Yeah, I didn't think it was that.
And again, that was out of 150.
50.
We're right at
Good.
150 loans.
Yeah. Okay. That's not bad.
No, it's not. That's not bad. And of those, I believe all of them are either worked out, caught up, except for one. And I think that's
And we're still negotiating.
and we're
on
still
that one.
working on that one.
Yeah.
So I mean, 4 out of the 5, 80% is taken care of.
Yeah, that's
But
awesome.
that said, the delinquencies and the defaults all go back to our original upfront underwriting. We're very
Yep.
conservative. We require income and bank statements, so we require assets as well,
Well, just
experience, and then in worst case, if we do have to take them back, they're properties that we know we're going to sell quickly.
Mhm.
and in the prior show we talked about why do we get bank statements, why do we get all these things, and it's like who saw, like we don't have a crystal ball, who saw COVID-19, a pandemic
Mhm.
happening, who saw the crash. Some people claim they did, maybe they did, I don't know, but we don't know these things. So the best way to protect you, the borrower, us, the lender, and then whoever the investors are, is to get all these things up front so we all can see and know what the plan is if the worst happens.
Right. Right. And really the almost the worst did happen with this big
Mhm.
virus that hit.
Yeah.
We were very, very fortunate to have been prepared for something like this. we knew there was a correction coming, but we didn't know it would be this.
No, yeah, we were preparing for a correction.
Yeah.
We didn't know when or how, but this was surprised us. But at least we took measures in place. We had measures in place to protect ourselves, our investors, and our borrowers.
Yeah, and we can thank the masterminds that we're involved with. Freedom Founders was a big part of keeping us on top of our game, keeping us focused on, hey, what's the worst thing that could happen, and making sure that we were thinking. It's one of the great things they do is they look far into the future, and
So
we were just thinking what could happen and
Yeah,
how to fix it.
And regarding future outlook, the pandemic really accelerated the buying and
What was going to happen anyway?
well, yeah, but I'm talking about on the single family side of things. It really accelerated the need for single family housing, and we are already in in certain segments, especially the affordable side of things. There was already a shortage at that time. Now there's going to be a lot of people that are going to have to change careers or not be employed, and the government has shoveled a bunch of money out there, and a lot of it's going to stop soon. So I do anticipate you're going to have some
Another
foreclosures
uphill.
coming. I think you're going to see, in most cases, less foreclosures than we did, say, in 2008.
Oh yeah.
Because they would rather, well, number one, they would rather sell the note off at a discount than to go through the foreclosure
The banks
process.
would. They learned the same thing we did.
And then at the same time,
Yeah.
the underwriting since 2008 has been so difficult, and there's plenty of equity in the properties. And I don't see, except for in certain sectors, luxury properties, for example, I don't see
Which
the
we're
values.
not involved in.
Yeah, I don't see values going down. So I do not see a bunch of people being underwater in their house. I see opportunity for them to do maybe short sales or subject to type of sales. I think most people, and again, it depends on where you are.
Sure.
Mhm.
What was the national average on the equity in a home? Wasn't it like 70%?
Yeah, it's not bad.
It's well over 50%. I mean,
Yeah.
So we're not in a position where you're going to see a bunch of underwater houses and whatnot. There's going to be plenty of opportunity for other investment types in there as well. So I'm very optimistic going forward.
Yeah. And, having more foreclosures on the market is good for our borrowers.
Yeah.
Right.
I was laughing because, Bill, I'm very optimistic.
I'm really happy.
Yeah.
Debbie Downer strikes again.
Please calm down.
Oh yeah.
We'll leave the light on for you.
The next question, which one do you want to tackle next?
How about this one that says, under what circumstances would you be willing to provide 100% financing where the borrower comes to the closing with no cash out of pocket? 0. Stated differently, how attractive must a deal be in order to mitigate borrower skin in the game? 40% as is LTV. This would be a fix or flip, or more likely a transactional funding instead of wholesaling or funding for I don't know where the other part of the,
I don't know.
Yeah. Question would be.
Well, so the LTV matters, but what that question is really,
which is loan to value, just
loan
in
to
case
value.
you were
But
wondering.
what that question I think is really asking is, how low does the loan to value have to be for the lender to feel comfortable to just own it? And that's not what we're in. Like that's not what we do. Like we don't want to own property. We want, when the best way to say it is, when interests are aligned, we want the borrower's interest aligned with our interest, and the borrower should want our interest aligned with theirs.
Mhm.
And the best way to do that is for us to put money in and them to put money in.
Right.
And then we know that our interests are aligned. We both want the success of this project. And
That's right.
the borrower doesn't want it to fail because now they don't want to lose their money. And we don't want it to fail because we don't want to lose our money.
That's right. That's right. Somebody who wants no money out of pocket is somebody who has no money to pull out of pocket.
Yeah.
And if that's the case, you're sitting in a position where maybe you shouldn't be investing right now.
Yeah. I mean, and most people who don't have the money to get started on that, there's a lot of like you can wholesale if you're
Mhm.
willing to put in the work. You can JV with somebody, like if you have experience but you don't have the capital, JV with somebody who has the capital.
That's right.
Yep.
I tell
Yeah.
people that all the time.
Yeah, I was going to mention that. Find a private lender that's willing to JV with you. Are you going to make as much of the profit as you would have if you're borrowing it? No.
Yeah.
But you have to start somewhere
and build that relationship.
Yeah.
Well, and here's the thing: as a borrower, what I would be concerned about is if a lender is willing to give me 100% financing for everything, and it's a low LTV. What's that lender's incentive to not take the property back? So let's say you get into a maturity
point.
default, like you've made all your payments, but technically, to not
Haven't
pay the
sold it
loan
yet.
back at maturity is a break of covenants, and now the lender can take that property back. In that situation, we're going to work with you. We're going to extend you out, or whatever the case may be, because we want you to succeed. We don't want the property. But if the lender has all their money wrapped up in that property, will they extend you out? Will they just take the property back? Like that's a question
That's
that I would
right.
ask.
What motivation would they have?
Yeah.
Absolutely. So we've got a question up here. It says, commercial LTV
Most of your
rate.
Can we show that person's name?
Yeah.
Okay.
Yeah.
Most of your loans go to flippers or buy and holders. Yes, I would say that.
I get it now.
Yeah. Most of our loans do go to flippers and buy and so flippers make up, I don't know, on the residential side, probably 70% of what we do,
Mhm.
75.
Mm-hmm.
Is that, you think that feels accurate?
That's very, very accurate.
Yeah.
Very accurate. Maybe even higher a little
Yeah. Yeah. So buy and holders.
bit.
So when we do buy and hold loans, there's two different ways to do that. There is fixed to rent, and then there is just a rental loan.
Mhm.
Now the long-term rental loans, we're working on to get that back. A lot of people are working on that right now. That's not something that's there's a lot of out there. But the buy to or the fixed to rent, we do that as well.
And I've got a lot of people calling for those, fixed to rent
Mhm.
loans.
Yeah.
But the first thing I tell them is, hey, we're happy to do this loan for you, but you need to understand it may be longer than the 6-month term that you're getting from us
Exactly.
to get this loan refinanced, because those are the loans that have kind of dropped out of existence for a while.
Gotcha.
They're coming back. They're coming back though. That's
Yeah,
important.
Scott, you can take that question down now.
Well, and there was another question about the commercial LTV and rate.
Yeah.
Yeah.
Now, it's going to depend on the risk and the type of commercial properties.
Mhm.
Typically, commercial is going to be anywhere from 60 to 65% max
Mhm.
LTV. And again, rate's just going to depend on the property type.
Now, if you're talking a repositioning, that's, on a bridge, you can go up to 75 if you're just getting a bridge. Not necessarily with us, but
Yeah.
as a whole on the bridge lending, there are many bridge lenders that will go up to 75%.
Yeah.
Sorry, I was speaking specific to us.
Yeah. And that's kind of crazy
Yeah.
to go
Hope
up
that
that
answered
high.
your question.
So it's how attractive does the deal need to be to get that money down? I mean, we kind of skimmed across that. So how attractive does it need to be?
Well, we need to know that the borrower is going to make money. I mean, again, our interests have to be aligned. If you're doing a deal and you stand to make a 5% return, that's probably not a big motivating factor.
Mhm.
So yeah, it needs to be more attractive than that. Like we have to know that the borrower is going to make money.
Right.
Yeah. So what is that number? Usually it's 15% or higher
Mhm.
that
Mhm.
that the borrower is going to walk away with.
Hopefully.
Yeah, I mean, assuming all market conditions stay the same as when we close.
Well, and I think that's a thing too that we probably should talk a little bit about is, what people are going over. Really, we lend at 65% loan to value right now, and I think that a lot of people are going even greater than that amount, not only just up to 70, but to 75, and in some cases 80, because they say they can't find deals.
Yeah.
And that's really not the case anymore. They're not looking hard enough, which
Yeah.
is what the real problem is. But when you really go over that, that threshold, you are taking a huge, huge chance
Mhm.
that you're going to walk away with no money out of that deal.
Yeah. I mean, and it's important that, like I said, interests are aligned. Like everyone is successful. Like if a loan is too far swayed into the benefit of the lender, it's probably not a great loan. If
Yeah.
it's too far swayed in the benefit of the borrower, it's probably not a great loan. It needs to benefit both sides.
Yeah, that's for sure. Okay, so let's look at another one. I like this one. I think this is real technical like. So it says, where on the risk scale would you personally put hard money lending? If 0 is a government bond and 10 is a highly speculative investment, where in relation to the stock market do you rate hard money lending risks?
My first indication would, or my first question would be like, what government? Venezuela?
Good question.
We're
Good question.
assuming U.S. Treasury bond.
Yeah.
If you're comparing it to the stock market, let me say this. When you're investing in a stock, where is the value in that stock?
Mhm.
Do you have hard assets behind the stock, or can it wipe you out completely?
Meaning, does it own real estate?
Well, when you're investing in the stock market, or you're investing in companies, you're investing in the performance of a corporation.
Right. People that run it.
The vast majority of companies don't own any real estate assets. Now, they may own plenty of equipment,
Mhm.
but the vast majority of them, they don't own property.
Yeah, it's accounts
They
receivable.
lease them.
Yeah,
because it's better on their books to lease them. It's not a it's not a debt. It's not a what do you call it? I don't want to say a debt.
a liability.
Liability. It's not a liability on their books.
Yeah.
And that keeps their asset prices higher.
Yeah.
Right? Makes the valuation of the company higher when they
Appear higher.
Huh?
Appear higher.
Well,
yeah.
I mean, they're higher on
Yeah.
paper because they are.
Yeah.
But they don't have that dragging them down. So they don't own property. They just lease it, and it becomes an expense.
And I want to clarify, when they say 10 is a highly speculative investment, stocks are speculative investments. Just putting that out
Yeah.
there.
Now
For sure.
You got so
You've got history from blue chips.
what I was going to say is you have your large cap, your mid cap, and your small cap companies.
Mhm.
Your large cap companies, they're global companies, they're utilities, they're stuff that it used to be utilities. I mean, you got a lot of tech companies now that are large cap, but they run most of the world now. That being said, they typically do not have a lot of growth potential, but they pay dividends, and they're less likely to be affected severely in an economic downturn.
Mm-hmm.
Your mid cap stocks are kind of trying to be large cap, but they're less risky than small cap. Small cap, they're going to get pounded in a downturn, but they have an upside of growth. So if you're looking for income, you're going to be looking for stocks that pay a dividend, but the dividends are anywhere from 3 to 6%.
Yeah.
Okay.
Yeah.
The likelihood of those companies going under is pretty low. Okay, I get that. But when you're in real estate, you can deal with a smaller market company and still have great protection because the funds own assets. They own solid assets,
tangible assets that you can go up and touch.
There's only so much land, and
God's not making any more.
God does make new land.
Volcanoes.
The problem is it takes a really long time for them to become inhabitable.
That's true.
So there's a commodity that there's only so much of, right? And for me, I would rather be in, and this is, everybody's got their own opinion, but for me, I would rather have my investment backed by a solid asset. Now, the difference between investing in gold and silver, and those are solid assets, you can actually use it if everything really goes south. You can use it as money.
Yeah.
But if everything
Yeah,
goes
to
south,
barter.
But if you're having to use your gold and silver to
We're
make
all in-
payments
we're
with,
all in
100%,
trouble.
if it goes that way, chickens are worth way more than gold.
And I got lots of chickens. I'm good.
And I use the gold analogy where gold is fine. It goes up and down in value. But frankly, the only thing gold does is if you buy it, and you call it a hedge, but it's only a value if you sell it for more than you paid for it, right? A house, for example, a rental property or any kind of house, the values in a home can go up and down, just like that, right? But if the value of the home goes down, you can always convert it into a rental,
Yeah.
and it's like gold that pays you a dividend.
Right. So if we're looking in this scale, where what would we think that hard money would fall if the government bond, which pays almost -0.
Right. So I'm going to say it's going to be more in the 4 range, because you still have the risk of hard money loans are typically loans that have some sort of distressed property involved, which means you're fixing it up and there's a construction aspect to it. And that is more risky than financing a single family residence that's ready to move into.
So I would say it's really probably a 2. And the difference would be if you're doing it yourself, if you're lending yourself and you're lending on one asset at a time, it's probably a 4. If you are putting your money into a fund that's diversified across hundreds or, even potentially thousands of assets, it's a 2. Now you are investing in something that, if we track the stock market, it goes like this.
Right.
If you track short-term lending on 12-month loans or 6-month loans in a fund, it goes like this.
Yeah.
Yeah,
that's
so,
right.
So what are you after? So when I look at something that looks like that, it's a low risk.
Yeah.
Well, and that's why I gave it a 4.
Yeah.
You're lending it yourself. It just says hard money lending.
Okay.
It didn't specify that you're in a fund.
But I like the fact that you brought up a fund, because again, you've got that herd safety.
You're able to minimize your risk even more if you're in a fund.
Yep.
If you're doing the hard money lending on your own, not only do you have the activity that you have to account for, because it's not a passive investment.
Yeah.
But at the same time, you still have the asset behind you.
Yeah, just like a mutual fund tends to be more of a safety net than if you were going stock after stock.
Yeah.
Let's
stock
put
per
it this
stock
way:
on that.
when you have a hard asset backing your investment, you're much less likely to lose principal than you are when your asset or your investment is just backed by the performance of somebody running a business you have no control over.
Yeah, you hit it. I mean, it's an asset that is a asset that you can sell or you can convert into a cash flow.
Right.
So, I mean, I think when you look at that, especially if you look at the funds, I like it better than a government bond for sure. I mean, the yields are a lot higher, and you have a hard, like you said, a hard tangible asset that you can go, see and touch. It's a pretty, as far as my personal opinion, it's a low risk.
Yeah, much lower risk. That's awesome. Okay. So let's see what else we got going on here. Okay. This one is a scary one, and important, very important. Would you or any other hard money lender provide funding for a second mortgage to acquire a subject property with a first that already has a first? If so, what would the deal metrics, LTV, exit plan, loan to cost need to be for approval? That's a big one.
That's a good question. There's a lot packaged up in that question.
It sure is. First of all, just hit the second mortgage part.
Would we do a second mortgage? I guess, can we? Yes. Would we? Probably no.
Unless we were in first position.
Unless we held the first lien position, and then
why do we care about that?
Well, because if you watched our last episode, you can first lien position is the control. If let's talk hypotheticals. If we would lend in a second lien position that we weren't in control of the first,
If we know the first.
if we know the first and we have the ability to
Yeah.
talk with them, our CLTV, which is combined loan to value, would have to be at a threshold that was palatable to us, which is probably under 70%.
Mhm.
We want to leave at least 30% equity. So if your first lien is at 70% or higher, we're not going to do it.
Right.
If we have that equity, we could potentially do it. The rate's going to be higher. It's a higher risk. What I see typically, and what do you see in typical second lien rates?
Well, I'm seeing second lien. They're in the teens.
Yeah.
You know, they're definitely in the teens,
Yeah.
13, 14, 15%, sometimes higher than that.
Yeah.
You know, it needs to be up there. It's a scarier position to be in.
It's more risk means that there has to be some compensation that entices the lender to take on that risk.
And the rates really coincide with the combined loan to value.
Correct.
If it's over 70%, that those teens are going to get higher and higher.
Yeah, I mean, if your combined loan to value is under 50%, okay, there's 50% equity even with
Absolutely.
ours.
That's a good safe place to be.
It could be. Yeah, it could be. Was LTC loan to cost on that? I mean, so if it's a rehab, or it's probably the loan to cost doesn't really matter too much on the second. Now,
why do people care about loan to cost? Talk a little bit about that. Why it's even a little bit important.
Well, so usually you're going to see it more on new construction.
Mm-hmm.
And you just want to control the cost that the lender is in at. So if let's say someone brings a lot and the lot's worth $100,000 and they already own the lot and they need $100,000 to build a house. If in the house when it's done is worth, I don't know, $300,000, that loan to cost is pretty low. Even if we lend them the $100,000 for we're at what? Like we're at 50% loan to cost.
Mm-hmm.
So that's okay. So the lender wants to make sure that they're not putting all the money into the project to make sure it happens. Again, we go to this aligned interest. We want to make sure that the borrower is putting money in on the costs, usually on the front end, to mitigate risk for the lender so that as we move along the project, interests are aligned. Because usually when you first get into that project, your LTV is the highest it's going to be.
Mm-hmm.
And then as you work on the property, the LTV begins to lower and lower and lower and lower.
Because the property is becoming more and more valuable as it gets finished.
So we want that loan to cost to be lower so that at the beginning, we're not all the money in.
Right.
Yeah.
Right.
So I guess that's the simplest way I can explain it.
And that was a good one. That was a good one.
We have another question. Which, in our opinion, is better, a HELOC or a cash out refi? Well,
It depends.
What do you want to do? Yeah. What do you want to do?
I'm giving you the attorney answer. It depends. And it does. Here's the difference. A HELOC, you can go ahead and get approved. And if you don't need the money, you're not paying payments for it.
Mm-hmm.
Right? You only pay it when you draw out of it.
Mm-hmm.
A cash out refi, you can get the cash, but you're making higher payments because you increased your loan.
Right.
Yeah.
Or if it was free and clear to begin with, now you have payments.
Yeah.
That said, you can have a HELOC in place for several years, and then all of a sudden the bank decides they don't want you to have a HELOC anymore, and they freeze your account.
Yeah.
And you can't use it again.
Yeah.
So if you get all the money out at once, then you already have it. Now, the great thing about a cash out refi, there's no tax consequences for that. Now, a HELOC, there's a little iffiness in there whether they call that income or not. So
I choose to say no.
it depends on your CPA.
Yeah.
Yeah.
And if you're getting audited and how nice you are to the IRS agent.
Yeah. Well, and so which is better? It just depends on the situation that you're in. If your house is worth more now and you still are paying PMI, and you can refinance it, get rid of the PMI, and you can lower your payment, and that's important to you, then now obviously a cash out refinance or just a rate and term refinance. If you want money to improve the value of your home so that eventually that you can refinance it, or you want to leverage your home's value or equity that you have to do other things, like maybe invest in notes, and you pay your HELOC at 4% and the note's paying you 10%, and you arbitrage the 6%, that might be a better route.
Right.
So
I like having a HELOC personally, because even though that money is available to me, it's not showing up on my credit as being money that I've dipped into. So it helps my credit score a little bit, that I have that availability that I'm not using.
Yeah.
So now when I use it, it's going to change things.
Sure.
Yeah.
At the same time, HELOCs are generally set up as a revolving line of credit.
Right.
Which means
A little more expensive,
the way
right?
you're paying the interest is different. And at the same time, it's always going to be an adjustable. And if you, as low as rates are now, if you
Need to lock it in.
you can get interest rates in the low 3s, maybe high 2s if you're at a 15-year term. Lock that baby in.
Yeah. Yeah.
And take the money and invest it into something that's going to pay you a lot more.
Yeah.
Yeah.
You know that I told you, or in the earlier show, that I was talking to US Bank. They are actually doing investor loans right now in the 2.8% range. I haven't seen that. I don't think I've seen it ever.
Yeah,
With a 25%
really
vacancy.
cheap.
It's yeah. It's a yeah. Then there's that.
I'll give you a 0% with a 50% vacancy. See if you can qualify.
Yeah, that's a pretty incredible. I've wondered if you always
Wondered if you or someone could do 100% LTV of property after repairs at 60% of home value. So 30K buy, 30K repair, 100K. People would, if you want to do something like that, but again, why wouldn't you want your own money in there? Again, I guess most people require between 10 and 20% of the purchase price down. And, from the lender's perspective, if you say, hey, I just want 100% financing, I don't want to put my money in it, then, why is it a good deal? If you won't put your money in it, why is it good?
Yeah.
Why should we put our money in it?
100% financing is hard to find anywhere.
You can find it with private lenders, like, or people that, are friends, family, et cetera. You might find it with some hard money lenders, but
Yeah.
I think the vast majority take the stance of aligned interest. And if it's a good deal, then you should want to put your money into it as well.
Yeah.
All that said, I've been in the mortgage business a long, long time.
Because he's old and he's hungry.
Yes. And the consumer mortgages, out of all of them, the VA loan is the highest performing loan that's out there.
Yeah.
That's for a couple of reasons.
And it has been for a long time.
One of them is the fact that veterans tend to be a little bit more disciplined than the general population. And at the same time, they underwrite the income differently than any other loan. When you do a debt to income ratio, it's the same debt to income ratio whether you have a family of 2 or a family of 6. With a VA loan, you have to set aside a certain amount of money for every member of the household.
They're a little
So
tighter.
they're a little tighter on the income part of it. So 100% financing doesn't bother me as much. I don't think you necessarily have to have so much skin in the game. The reason that we do it is that because we're looking for more cushion, because we had the COVID thing happen. We used to do 100% financing. You still had to bring money, so you still had skin in the game.
You still had to bring
but you were
closing
bringing
costs.
your closing costs and fees. But now we require it because we want to make sure that we have a little bit more cushion in each one of these deals, because we really don't have a crystal ball, and we're not sure exactly where values are going to be. We're optimistic about where they're going to be, but we have no idea. And we'd rather be
Err on the side of caution.
more on the conservative side than otherwise.
Yeah.
Hope that helps.
Yeah.
But
there's plenty of private lenders that would do that.
I'll harp on it. It's like, if your loan size is, under 200,000 and you're complaining that you have to bring 20% or 10, or 20, or not 20%, but 20,000 down or $10,000 down. I mean, the confidence of the lender starts to go down. Because when we're talking hundreds of thousands of dollars, 10 or 20 is usually not a big number. And, even if you don't have the money, that's not a big deal. But if you can't find a way to get the money, then it becomes a question of how reliable can this borrower be?
Yeah.
If you told me today, Jonathan, go find $10,000 for this, I can go find $10,000. Now that's, not to say that I would necessarily have it in my account, but I can talk to somebody. If it's a good deal, I can get somebody to work with me on a JV or something for $10,000.
Yeah. And if you can't do that, then you're in trouble.
Yeah.
That's because we're
out of time.
We have network stuff that we do.
Yeah.
We do a lot of networking, so we know people.
Yeah.
If you're new to the business, sure, it's going to be a little harder to find that kind of stuff.
Start networking.
The end of that question, I had something really smart to say, but we're going to wait till next week because I've forgotten it because I'm not that smart. All right. Thank you so much for joining us. I hope we answered some burning questions for you. Don't forget to like, share, and subscribe. If you want any information on being or becoming a borrower with Carolina Hard Money, go to carolinahardmoney.com. Click on the borrower tab. If you're looking for passive returns through notes and lending, go to the same website, carolinahardmoney.com, and click on the investor tab.
And check out our website for Ask the Ugly Question sessions. We're going to have a lot of these on the website for you to learn what you need to learn about borrowing and lending, right?
Absolutely.
That's right.
All right. Have a great week, everyone. We'll see you next Thursday.